Hi everyone. Welcome to this how many times? Two times. Super important video on a topic which is going to stay with you the longest. I'm talking about none other than the concept of earning per share. And I'm not only talking in terms of the career profile of the finance major students, but also for people who want to do something in consulting, something in marketing HR. The concept of EPS, as it is more famously known as, is in terms of importance, is second to none. So people, just make sure that you look at this pre-watch video perhaps twice or thrice in case you feel a little underconfident, because you have to really get this before entering the class. Okay. So not only that, it's super important. Good news is it is super easy. So that makes it like a low hanging fruit from an exam standpoint, from a job placement interview standpoint, and also from a practical application of the knowledge that you're gaining in terms of these classes, so to speak. Okay, people. So I'm going to start off by asking a very simple question, which I am sure that you know the answer by now, is the difference between the earning and the cash flow. Of course, earnings are more on accrual nature, and cash flow is more in terms of the receipt or payment of cash, which is the liquidity part. The name of this topic is earning per share. That means the first aspect, and I'm going to explain all three parts. The first aspect is the accrual part, the earning part. So make no mistake that we are still into the paradigm, the envelope of accrual. That means we haven't really gone out of the income statement. Perhaps we are now drilling deeper and looking at one of the application areas for income statement, the performance measurement that we have been talking for all these while. Okay, so that's the first part, the earning, accrual. Second part is per. That means we are going to talk about something which is at a unit level. It is for each unit. You know, it's something divided by something. So you got to just think about it that if I have 20 chocolates and I have 10 students, so how? So it's not a question of what's the total pool of earning available, how many total chocolates are available. It's a question of how much is the quantity that each student gets or each shareholder gets. So it's on a per basis. And therefore the leading to the third part, which is on the share part, is also a point of debate here, because there are two types of shares that you know. One is the common share, the equity share, the real owners with a lot of what you call the voting power, the ownership pattern. And the other ones are really the mollycoddle, the preferred lot, wherein we say that they have two preferences. They always get paid first in terms of the normal dividend and also at the time of liquidation. So here in the topic, earning per share is essentially the concept where we are going to talk about the common equity, not the preferred equity. Okay. Why do I not talk about preferred equity? Very simple, because their payment that the business has to make, very similar to debt, is fixed by the contract. So there is no fun in calculating anything that you have by nature fixed by the contract. Yes, the volatility in earnings is there in context of equity shares, and that's exactly what we are going to talk about. All right. So pretty much that's a good context to start with. Now, I'm going to again request you to go back to your initial few classes where we spoke about a couple of cases and we looked at the structure of the income statement. So it really starts with sales, then have few expenses, and then finally comes as the net profit. And in between, you can have interim levels of profit. So here is what I am talking about. The level of profits that you can calculate are more than just one final profit. So this is your net income. But that's really not the only level of profit. You have one profit right here in form of gross profit. Then you have cash operating profit. Then you have the operating profit. then finally profit before tax, and thereafter the profit. You say net profit or net income. That's really, the synonym of the word profit. But which profit am I talking about? Because you're talking about the earning. So which earnings am I going to divide among the total shareholders? See, because as a concept, it's not very difficult. Look at earning per share. How much is the business able to generate in accrual terms for every shareholder? That's simple. I mean, it's over, period. But there is a bit of debate under each aspect. So that's what we are going to do in our live classes through numericals. But I want to just open up those Pandora boxes right now. So the first Pandora box is in terms of the accrual profit, which one should I take in the numerator? Because my formula is very simple: the total profit or total earnings divided by the total number of shareholders. That's it. So if let's say 20 divided by 10, 2 is my answer. The point is, how do you arrive at this 20 and how do you arrive at this 10? That's what I call a Pandora box here. Okay, so my first Pandora box is the numerator. Which numerator should I consider out of these 5? And you now also know that there is an extension of this income statement right here. Once the profit is calculated, you are aware. Remember the Baron-Coburg case study? There were alphas and betas. Alphas were the necessary payments and beta were the voluntary withdrawals. This second statement is all about beta. You see beta 1 and you see beta 2. These are different types of shareholders. Nonetheless, be it preference or be it equity, even payment to preference is optional. The amount that you got to pay is fixed, but whether or not to pay is optional. So I still would like to call it under beta. Now, so not only 1, 2, 3, 4, 5, you have 6 and 7. 7 level of accrual pools available. Which one of that is relevant? That's something that you got to worry about. And for that, to explain that logically, I have a simple table here. I want you to perhaps pause the screen and look at this, read it through, because as a B school student, you must be very, very habitual of looking at a lot of graphs, tables, imagery. These days, people are talking about infographics, etc. So the way you got to read it is, perhaps now you have unpaused the video and it is continuing. The way you got to read it is, this is essentially the people who provide the capital at different contractual terms, and these are different levels of profit, perhaps 3 out of 7 that I just shown. So there are 7 types of profits that you can have. Here are only the selected 3. Now, who owns what is the key question here. I'm deliberately not cluttering the screen here, and I'm starting with EBIT. EBIT, if you remember, is your operating profit, and a rival of EBIT is your typical sales minus all operational expenses, which typically means that the payment to neither debt nor preference nor equity has been done. So you see, up till now, starting from sales, and you're talking about EBIT, only the operational expenses have been met, which means this level of profit belongs to equity, debt, and preference, all 3. No one of them can really come and say that, hey, here is EBIT and this is the profit that I'm going to take. You can't do that because none of the 3 have been paid. Now, the second level of profit talking about is PAT, profit after tax, which is right here. Up till arrival of this, you have paid for the interest on debt. Different names, debentures, bonds, notes payables, etc. All type of finance costs have been paid for right here, which means now whatever is the accrual profit, debt will not have a control on it. This PAT belongs only to equity and preference by the simple logic. Why? Because preference have also not been paid so far. And come the next level of profit, which is earning attributable to equity shareholders or common stockholders, different names. That's the level of profit, arrival of which is a testimony that you have also paid preference dividend. So, hey, that's to me the most suitable, relevant level of profit, accrual earnings, which are available for distribution of the shareholders. The confusion that I will give you in the live classes is 6th the right numerator or is 7th the right numerator. I'm going to talk about questions like, 6 belong to preference or equity, or only preference or only equity. In the live class, we are going to debate what is the nature of difference between 6 and 7. In the live class, we are also going to debate why is 7 called as retained earnings. Okay, that's how perhaps some of you might also recall Baron Coburg case and be able to answer that. Okay, so that's a pretty much the logical classification of, or taxonomy of different levels of profit. So the most relevant for the purpose of earning per share is this, because my focus right now is only on one entity, which is the common equity, and I would like to pick up something which belongs only to common equity, which means all other capital providers have been paid off, right? So these are going to be the important questions, or should I say the topics within EPS that we will debate upon. How to calculate the earning attributable to equity shareholders, typically my numerator. How to calculate my denominator. You see, there is something written as weighted average. I have some numerical built for you. And why do we take weighted average? That's the logic number one. Number two, once you have agreed on that logic, how do you calculate that? These are the two simple points in denominator. And then I'm going to give you certain special transactions where you're going to see that the calculation of weighted averages, point number three, is actually a subset of point number two. And it's very interesting that you follow certain principle for all others, and for few special transactions, three in number, you're going to somehow do something which is exactly opposite of others. That's going to be the interesting part. And then finally, perhaps towards the end, this is a little difficult, this is relatively important, but I'll be okay even if you don't master this concept of diluted EPS. Just remember two words whenever someone talk about diluted EPS, they're talking about something hypothetical, and they are talking about something which is a negative situation, very, very pessimistic environment, the worst case possible. So people, your problem right now in these, the class that you are going to talk about is not the diluted EPS. That's really like the icing on the cake. It is going to be the basic EPS calculation. Just say, just stay logical and continue to believe that you are under accrual phenomena. It's the income statement that you're going to derive that information from, and there will be a bit of maths involved. No algebra, integration, differentiation, etc. Simple weighted average concept. Okay, I am super excited to meet you in the live class as far as EPS is concerned. Lots of numericals are waiting. Really looking forward to it. Thanks everyone. See you very soon.